Okay, there I am.
Hey.
All right, guys. Nice to meet you all.
Hello.
Welcome.
Nice to meet you.
We're
Okay.
live, so make sure your YouTube is off if you're on the YouTube channel. Oh, sweet.
Sorry, I'm just getting all these links posted. Okay, cool. And we are ready to rock. Open that up. Here we go. Rock, how are you doing?
Good.
Good. We'll just give people a minute or two here to join us. Let me get. I gotta close some of this.
I'm gonna start editing like hype sizzle reels off of our governance calls, like NFL like recap style.
Just make sure you fry them extra crispy. That's typically how I prefer my memes and videos.
Just gonna like have the like sizzling like metallic like lower thirds slapping on, like, you know,
Hell yeah.
dun dun dun, like.
Okay, we got 5 watching. 107. All right, we're just gonna go ahead and kick this bad boy off. I'm gonna get my screen sharing going here. This is the one we want. Actually, maybe I'll stop the screen share. We can do maybe the intros because we know that the intros are coming first. Anyone who wants to do a little intro of who they are, feel free. I'm Trent, obviously. I do, community management, strategy, random product development, one of the original YAM launchers, kind of all of that good stuff. Excited for this call. We're going to mainly be discussing the YCP protocol design and some of the action items around there, and just starting to get some community consensus and around certain design aspects of that protocol.
Hey guys, I'm Brock. I'm the core dev, lead dev.
Yeah, I'm Jim Wilcher, aka Designer on Discord, and I basically kind of helping out with branding, marketing, not really design yet, but trying to establish a foundation as well as come at this from or offer some years of experience in more or less high-end marketing and branding.
Excellent. Yeah, we've really appreciated the branding work that you've been captaining. We need that kind of like ownership over specific departments and kind of areas of the community and protocol. So that's been super awesome to see. And Fedas has been doing a lot of that as well. You want to go ahead, Fedas?
Hey, Yam fam, Fedas here, working on the treasury investment portfolio, contributing strategist. Thanks for having me on.
Hey guys, I'm Chris, KW710, contributing strategist, general entrepreneur, crypto enthusiast, and filmmaker as well.
And Chris has been coordinating these dev calls and kind of like making sure that we're all set up there. So that's also been a huge help.
Hey, I'm Huddled One, and I'm just a investor and core strategist and general blockchain enthusiast.
Is it my turn? Hey, I am Mick Hagan, and I'm just a fan of YAM. I'm an investor, entrepreneur. I'm the CEO of a company called GenesisBlock.com, building a digital bank. I hope we can someday integrate with YAM somehow, some way. But that's me.
Cool. Thanks, fellow contributors. I think it's great to do little intros so that people know who's a little bit behind those Discord names and things. I'm going to go ahead and start screen sharing the doc here. So again, we're mainly going to focus on some of the YCP stuff, but before we get into that, just want to like quickly run through some of the things that have happened in governance in the past week and a few looking forward items. Though like a lot of our attention, especially on Brock and I's part, is, and I think several other contributors, once we get this design kind of finalized, it's really going to be going towards that YCP. But we do have a couple other things that we also want to be working on in tandem. So in the past week in governance, we processed the contributor payments. So you can see that transaction, verify it, see where all of those funds went. We've also pushed the kind of big update, as Brock and I have been calling it, live on chain. So that's eligible for vote right now. It's passing handily. And so everything including in that is that the Treasury is going to purchase ETH via the ETH-YAM sushi swap pool. That pool is going to be incentivized with 5K balance of underlying YAM per week. People depositing in that staking contract as LPs will now be able to participate in governance. So we won't have this whole issue with coordinating exactly when votes are happening such that people can withdraw, and that huge hassle. And then lastly, we're going to be farming sushi for the Treasury with that deposited SLP in the incentivizer, because that sushi swap currently has a staking contract for SLP as well. So that's a great way to kind of leverage what we're already doing to build the Treasury a little bit. And then lastly, we have the ETH OTC purchase on chain as well. This is a resubmission because part of the input amount was incorrectly formed when we initially made the ETH OTC purchase. So those are kind of the things we have running live right now as far as where our agenda is for kind of this weekend and next week. I think we really want to get some of the contributor frameworks that have been posted in the forum and on Snapshot to actual on-chain implementation. So that includes the contributor vesting pool that is about like 790K balance of underlying YAMs that can kind of act as an employee stock option pool in terms of the way in which it can be used to vest full-time contributors to align incentives in the long term. And then the other thing along with that would be kind of portioning off a piece of the YUSD or ETH in the Treasury, as well as potentially some of those EMs from the contributor vesting pool into a more kind of ongoing payment for full-time contributors, and starting to actually kind of define specific roles that we want to be paying full-time ongoing contributors for, and start creating some more structure on that. So I posted a contributor framework in the forum a couple weeks ago, and FedUs recently has done some work to update some of that stuff. So we'll get that in Snapshot / on-chain probably next week, such that we can start kind of building out a consistent, ongoing team, which I think is going to be really powerful for, bringing on more and more contributors in the future, as well as kind of solidifying these core contributors and defining exactly what they should be doing, and making sure they're getting compensated for those kind of more well-defined roles and responsibility. I think the other thing we are also working on in tandem, in addition to like this organizational infrastructure and the YCP, which we're going to discuss, is some of the treasury management items. So Fedas and Krugman have really been captaining that ship, doing a lot of work on like beta correlations and what exactly we want this investment portfolio to look like, as well as how we're actually going to implement it via SET protocol. So we've been working with the SET protocol guys, hopping on a couple calls with them. They're pretty fired up about it. We're pretty fired up about it. I think it's going to be something that's really useful for us, and potentially that other DAOs that are interested in, that have an active treasury that would like it to be managed in some way, they might be able to farm it out through YAM's active treasury management. And that would then generate some management fees for the YAM treasury. I think there's going to be a lot of cool potential there. Fedas, do you have anything to add on those points?
Not at the moment. I guess we'll go through it a little later, or if you want me to add in later.
I think for the rest of this call, I'm really kind of hoping we can really focus in on the YCP stuff.
Oh, sure. Yeah, there's we're just working on it. Krugman has updated or is currently actively working on the smart contracts that go into the set. Designing around it. I'm working on the guardrails and just kind of getting the information together for the community. We're looking at probably close to a month to get the set in a usable form for us. But of course, throughout this month, we're going to be updating the community on kind of what guardrails we need to put in place, what's moving forward, what kind of investment should we put inside. So there's just going to be a lot of stuff, but we'll go over that a little later. Of course, I'll be on Discord. If you guys have any questions, feel free to just ping me. And then I'll be uploading stuff to the forum.yam.finance.
Excellent. Okay, well then I think we should probably just dive right into the product spec, unless there are other issues that people want to chat about before we kind of focus our attention there, which is totally fine. If there are other issues, I think now is a great time to bring them up and discuss, or we can just get into the fun of the protection protocol. Cool. We're gonna do it. So I posted this kind of spec overview in the YCP channel on Discord. So it's a lot of words, but it gives a pretty comprehensive view of how we're thinking about the protection protocol right now. You can see that there's kind of this first option, which is detailed here and with a schematic, as well as a little bit more complex and flexible version that is also detailed here with, again, obviously a little bit more complex schematic. And so I guess, I don't think it's a mystery to anyone why we're focusing on an insurance protocol right now, but obviously there's kind of limited options in the space for it right now. And we're continually seeing hacks and exploits that are causing people to lose fun, whether it was Farm a couple weeks ago or last week, who knows when that happened. It all is a blur. Or I think Percent Finance, which was a fork of Compound, just was updating some of their rates and locked like $1 million of funds in their smart contracts. So it's a huge need in the space, and I think a lot of people say, "Oh, we need better audits. We need more audits." What's clear is that audits are not a silver bullet for these issues, and insurance is going to be one of the insurance. I should say protection. Some form of protection is going to be the thing that that really can help users in a much more kind of sure way, because there's essentially always the potential for some exploit to occur. And so, we've seen a number of protocols popping up in the last, 2 months to work on addressing this issue. And I think what we're presenting here with the protection protocol is a really novel approach to how this is being done. That should fill in some interesting gaps in the market. It's obviously non-KYC, sets us apart from Nexus. It has a perpetual ERC20, which we can get into. And so I'm pretty excited about what we've put together here, and I want to run through it and then kind of get some feedback on it, get some thoughts, and then I've got some questions that I've been noodling on and would love feedback on. So to kind of kick it off, there are really two in the protection protocol. There are really kind of two contract types that exist. First are these meta pools, which underwriters go in and deposit funds that would cover the second type of contract, which is the contract pools. These contract pools are individual pools such as, urine vaults, compound borrows, farm vaults. They're all looped in to the protection meta pool. And so the underwriters just fund the protection meta pools, and they're covering all of those underlying contracts. Where on the protection seeking side, you are specifically buying one contract pool. I'm just interested in getting coverage in the urine vaults, or I'm just interested in coverage in the compound borrows. So ultimately what this allows is for the protection seekers to get much more granular in like the exact type of, the exact protection that they're looking to get, while also still ensuring a significant payout in the event of an exploit, due to the fact that there's this centralized point of pooling with the protection meta pools that are covering multiple protocols. So getting into some of the specifics of how this is all going to operate, the protection meta pools, we're really trying to make this as permissionless and immutable and governance light of a protocol as possible. And so anyone is able to build a protection meta pool composed of, any set of underlying contracts that they would like to offer coverage on. And so a user would create this protection meta pool and then submit that to the arbiter. In this case, it would be YAM, but you can pick any arbiter that you really want in this system. So they submit a proposal to create a meta pool on chain via transaction, and then the arbiter, in this case YAM, would say, yes, I approve to determine the validity of any exploits on those underlying contracts, and the pool is created. So as far as YAM Finance would go, in terms of our UI support, we would essentially be supporting any meta pools that we agree to arbit, or be the arbiter for. But that doesn't preclude other users from creating their own interfaces, picking their own arbiters, whether it's Chainlink or Kleros or anything like that. Does that all make sense so far?
Yeah, just a quick question on the for the protection seeker, will can they also kind of bundle, like have a coverage for over a bundle of contracts, or will they always have to specify a specific contract? Like what if a protection seeker just wants, let's say they're an LP on Uniswap and they're LPing multiple kind of different assets or pairings. Do they have the option to get a bundle, or they always have to specify the exact contract?
So it comes down to right now we have meta pools, basically underwriter pools, as being conceptual in what they cover. So for example, a meta pool could cover YEarn, Compound, and DYDX and Uniswap in general, right? And so it's up to the underwriter to basically provide protection on all of Uniswap. I don't know that that will be popular. So you're kind of playing this balance, right? Where yes, in theory, there could be an underwriter that will underwrite the entirety of Uniswap. But what happens when there is a deflationary ERC20 or something that ends up screwing up the LPs for Uniswap? Should that be covered, yes or no? And so most likely what will happen is underwriters will lean towards being more specified in what they want to underwrite. So,
but could a coverage buyer or a protection seeker, do they have to always specify the specific contracts, or could they kind of get this meta pool as a coverage buyer?
They buy the concept. So a meta pool has a few concepts: Compound, DYDX, Uniswap. If you want to get coverage on all of Uniswap, you buy the Uniswap in the meta pool. Does that make sense? And that covers basically.
So then you could also buy, as the user, you would have, if you want in that meta pool coverage on both Uniswap and Compound, you would need to buy Uniswap and Compound. There's no mechanism at this point to like loop those together in any way. But I don't think that that's a huge UX detraction. I think it's probably
yeah, I think that's fine. I think the main UX detraction that I'm wondering if it's required is if a coverage buyer has to go in and specify individual smart contracts versus the concepts. But it sounds like they'll be able to get kind of the concepts.
Yes.
Yeah, exactly. And I think what I really like about our system and this way in which the conceptual underlying pools can kind of be anything is that it can be all of Uniswap. It can be just ETH on Uniswap. It could be, all of the C tokens or of Compound or all of Compound. And so you can end up getting like really, really granular in terms of like what that conceptual coverage is, or be really, really broad. Which is something that we currently are not seeing on the market. Right now, it's like you can have coverage on DYDX, you can have coverage on Curve. And so I think that has the potential to be a really strong differentiator for us.
I might just be fundamentally misunderstanding this, so I apologize in advance. But you said that the protection pools, they cover multiple contract pools. So how does that actually look like? So basically, it sounds like the staked funds that are basically providing that coverage or underwriting that coverage would cover like a multitude of potential hacks. So is there a world where, like if you're staking in a pool that is covering, Uniswap and SushiSwap and YAM, right? And something happens to Uniswap, and then like a week later, something happens to SushiSwap, is there a risk of insolvency where the pool's already been drained or something like that?
Right.
So basically, the way we structure these payouts right here, your understanding is correct. So I just gone down here to the actual graphic. So protection sellers deposit funds into this meta pool, and then protection buyers pick a specific, conceptual framework of contracts in which to purchase coverage. If this contract gets hacked, the way the payout works is that all of the currently utilized protection that this pool has is immediately paid out, as well as any of the unutilized funds in the protection meta pool. What that essentially means is that these two pools will always be backed at least by 1-to-1, even if it's kind of a back-to-back hack.
Okay.
And so this gets in a little bit to how we're structuring, how you actually get coverage, which is also quite unique in this protocol, in that protection buyers are really staking funds in order to get their coverage.
So in a sense, it's similar to almost like how like a wire and vault works, where you're basically guaranteed your principal minus the premiums paid out up to that point. And
Yeah,
then there's remaining protection meta pool funds available, then you will get, you could be made whole, basically.
Yeah, and so you'll always get, even in back-to-back hacks, you will always get at least the same amount that you currently have deposited.
Gotcha.
And that's on top of what you have deposited, right? What you have deposited doesn't go away. You will get 100% return on your current deposits in the event of a hack at the minimum.
So just, I'm wondering from the flow of this, say I've got, $1,000 that I want to put in harvest.finance. One of the, one of the F pools, FUSDC. What do I do as a user? How much money am I spending as a user? Do I go to YCP webpage and I deposit from there and that deposits into Harvest for me? Or do I put my $1,000 directly into Harvest and then buy spend $100 at YCP to cover that $1,000? Or do I spend another $1,000 to cover that first 1,000?
Yeah, so you would go separately deposit into Harvest, the Harvest Vault, and then you would come to YAM in order to whatever we end up calling YCP website to then obtain your coverage. And so this gets in a little bit to the protection seekers. And so we see here, the protection seekers receive protection in return for staking their capital in the contract pools where a funding rate is applied to pay for the protection. You then, after you deposit, you then receive a perpetual ERC20 representation of the stake deposits. And so these essentially operate as C tokens that are tracking the underlying balance of your stake. And so that funding rate is then being constantly applied. Your underlying balance is constantly decreasing. But the amount of tokens you're having stays the same. So the protocol is essentially kind of always inflating the number of tokens.
Okay, so then you go through I understand you're talking about being backed basically 1-to-1 on the insurance product. So does that mean that as the user point of view, the protection seeker, that I'm spending $100 at a 10%, utilization rate or fee rate or something? So basically it's 10-to-1. So if I want to cover $1,000, that I spend $100, or am I spending closer to $1,000 on a bonding curve or something?
So that can be tuned, and we're still figuring out what the payout should look like. But ultimately it comes down to so the reason we have multiple pools in a meta pool, or multiple concepts in a meta pool, is that it actually boosts the payout if one of them gets hacked. So we want to make this as attractive for coverage buyers as possible. And so we don't have like a specified max or min payout right now, but it's based on the max utilization. So if, for example, a single concept has 50% of the entire meta pool usage, then you'll get a 100% return on your protection. If it's at 10%, then you'll get a 10x return on your investment. And so it depends on how much capital is being attributed to, or how much coverage is outstanding, essentially, to
Okay,
your
I see.
particular pool. Does that make sense?
Yeah, I think I get that.
Yeah, and it's one of kind of the core design things that I want to get feedback on, because let's say you put $1,000 in you're seeking $1,000 of protection. You as a protection seeker deposit $1,000. That funding rate is going to be constantly applied to that $1,000. So your actual amount of coverage is kind of decreasing along with the funding rate. On top of that decrease, which is fairly unpredictable depending on the funding rate, there's also the fact that your payout is determined by what that utilization is, and we can kind of always predict what the payout will be, because in the event of a hack, oh no, we fixed that. But the problem is, so you've got this funding rate that's decreasing your coverage over time, and you've got payouts that are reliant upon how much the utilization is, which leads to a situation in which the actual coverage that you're getting is a little bit unpredictable. And so it's not like really excellent for saying I have $1,000 in this farm vault and I want to get that farm vault covered.
But the thing is, you can say, all right, at a minimum, I'm getting this amount of coverage. You can always put a minimum on it based on the max utilization of a particular contract pool or concept. So when you say that a particular concept has a max utilization relative to the meta pool, that puts a lower bound on the amount of coverage you're ever going to get. On top of that, it'll never actually reach that. It should never reach that maximum utilization, because as you go up towards a high utilization, that's going to push the funding rate. And so people will leave, coverage buyers will exit, so they're not paying that funding rate. And so it has this mechanism where as your payout decreases, more than likely other people will exit because they're paying too much, or you will exit because you're paying too much for the coverage relative to the payout. And so we can kind of tune what the payout will be in general, assuming there's not a extremely risky pool that everyone wants coverage, then you're paying for what you're getting. And you should have to pay a lot. Based on where the ramp up is in the funding rate is basically what you can assume the equilibrium point will be, to where you would expect the payout to be 15x of what your initial capital is based on how the funding rate behaves, excluding any extreme risk in a particular concept, if that makes sense. Basically, I'm just saying the funding rate helps give an expected payout, and you always have a minimum payout that you'll receive and can calculate.
Okay, sounds good.
So sorry again if this is obvious to everybody else, but the premiums that are getting paid to the protection sellers, where is that coming from?
So that's the funding rate. And again, this funding rate is determined by the utilization of a specific underlying contract pool. And so as the utilization increases, say there's $100 of coverage available for this pool, as you get closer to $100 staked in that coverage pool, the funding rate is going to increase.
Gotcha. Okay.
And so then as we get into the protection providers, they receive the cash flows from these premiums, and in return for staking, they're covering multiple contract pools in these meta pools at any one time. And so if a exploit occurs, a portion of that seller stake is paid out to the affected contracts. And so the amount that is paid out is essentially, base level, the amount of current deposits in that contract pool, plus any unutilized protection funds in the meta pool. Does that make sense? So if you've got $1,000 worth of coverage covering 3 different underlying contract pools, each that has $100 in it, if the first pool gets hacked, it'll receive that $100, and then the remaining 900 is subtracted by the utilization by the other 2 pools, 100 and 100. And so then the unutilized portion is $700. So the end payout for that first pool would be a total of $800. That check out for everybody?
So what would be the downside potential for the protection providers? So let's say I put in $10,000. What is my potential downside on that?
Your potential downside is, theoretically, 100%. If all of the pools that you're covering get hacked, you could lose all of your funds. If any single, in the event of a single hack, which is more likely, your downside is, whatever the highest pool is, highest pool utilization, plus any unutilized funds in the protection pool would be your kind of max drawdown in a single exploit.
So the protection provider in a way has to be his own actuary. In terms of determining, there's a couple of factors, I suppose. There's the amount of money that you put in, and there's the duration of time. Is there a duration of time that applies to the protection providers as well? I know it does for the buyers.
They stake their funds, and those funds don't move except in the event of an exploit, and they're constantly earning these premiums. But they can essentially withdraw at any point that they want, but it is subject to a 14-day withdrawal period to ensure that, a hack doesn't occur and they just immediately take their funds out. So they're not quite so subject to, any sort of time decay or anything like that. They are definitely required to be their own, actuaries, risk managers. They have to determine what contracts they feel comfortable providing coverage for and what return profiles, make them feel safe to do that.
So given that, one thing I was thinking is, or wondering is, performing that actuary, I mean, I'm sure there's a group of people that are going to have a lot of insight into that. But if we're limiting our target market only to those, that might just be limiting. Is there a way to provide some data or some kind of information about, let's say, statistical information, industry-wise, about hacks and frequencies and whatnot, and be able to put that into almost like a dashboard or some kind of something that allows people to come in, take a look at the insurance offerings, determine if they want to be a provider, look at some statistics and make a determination, help them to do their actuary work, basically.
Yeah, that's a good point. And there's something called Codify by Consensus, and they give a safety rating for various protocols. And I think it's good to have a data resource available for people to use, so that they could go and see audits if a particular protocol is audited and whatnot. I think that would definitely be a very good resource to provide underwriters to incentivize, or at least give them the tools to making more informed decisions. I think that's good.
Yeah, I think DeFi Pulse also is doing a rating system now that is kind of in a beta mode. So.
Oh yeah,
Yeah.
How are contract pools added to a meta pool? For example, let's say there's a meta pool for a bunch of Yearn vaults, and then there's a new vault coming out. Is there a way to kind of like add a new vault into a meta pool, or would there need to be or a new contract pool into a meta pool, or does there need to be a whole new meta pool basically anytime something changes with kind of the underlying protocol?
So that's kind of the point of the conceptual, is that it inherently covers upgrades, as opposed to originally when we were talking about this, it's like these are the exact specified contracts that are covered. And so the point with like conceptual is you could have a concept that is Yearn vaults. And so it would basically cover any of the Yearn vaults that currently exist or will exist in the future. And so that's the idea around concept coverage. If I didn't answer your question, let me know.
No, I think that makes sense. I think as a protection provider, I would certainly be pretty nervous about, new contracts coming up, right? Like rug pulls that could happen when I'm not even awake, things like that.
Yes. So that's one of the things we're trying to balance here is as a coverage buyer, right? You obviously, you probably prefer protection over the concept and upgrades, so that I'm not paying for coverage on an old contract. And so it's just a balancing act between like, all right, do we want to favor the provider or the buyer? And what does the upgrade path look like for each? And the upgrade path for protection buyers is probably easier than the providers. And so we looked at that and said, okay, it probably makes sense to do conceptual because that eases the upgrade path for providers. But the flip side of that is it changes the risk profile potentially out from under the underwriter. And so it's a balancing act. And we're not saying we have the right answer right now, and would love more thoughts on that.
Yeah. And I mean, that's really where some of our thoughts were going with this more complex version down below, of basically being able to have a single contract pool that can be created and then added to basically any meta pool. That would essentially allow, if a new urine vault comes out, create a new contract pool, and then, you would still have to probably create a new meta pool, but you can essentially kind of upgrade to that new meta pool as an underwriter. The issue is that it just from a computational standpoint gets pretty heavy and really gas inefficient. So this more simple design, it's basically just if you have a meta pool that is, individual contract pools for every one of the urine vaults. If a new urine vault comes out, you're just going to have to create a new meta pool and, migrate your funds manually over to that new pool.
Well, but I thought Brock just said it could still be covered in the original meta pool as kind of the concept, even new contracts.
If it depends what that concept is. If the concept of the contract pool is urine vaults, and that's one contract pool with, farm vaults over here and pickle vaults over here, then yeah, a new urine contract gets just looped into that conceptual framework. If your meta pool is urine vaults, and then each one of your contract pools is, the Y curve vault, the Y dive vault, the Y, and then a new urine vault comes out, that new urine vault isn't going to be included in any of those other conceptual pools. So you would need to create a new urine vault meta pool.
Okay.
So how are these concepts expressed either in the UI or in the code?
So they're expressed in the creation process. Essentially, as you create a new meta pool, you essentially have an opportunity to, name the meta pool that underwriters would go fund, and then name each of the contract pools as well, and kind of include a description of exactly what that conceptual coverage is. And then the arbiter has to agree to those descriptions and understand them, and agree to determine validity based on those descriptions.
Okay, and then how do we prevent malicious arbiter? So say the arbiter is the one that's staked a whole bunch of capital to earn these fees on, there's a hack, and then the arbiter decides that they don't really want to pay out.
So
Go ahead, Brock.
you really can't, right? So there is some trust aspect to the arbiter. So just like in Nexus Mutual, right? In theory, they don't have to pay out anything ever, but you trust that they will based on reputation. And so it's fundamentally the arbiter you have to somewhat trust as an underwriter. So I, as an underwriter, I have to trust the arbiter. It's just but yes, the arbiter could be an underwriter as well and decide not to pay out. But then they instantly cut off any future revenue from being an arbiter, because no one would ever underwrite on any of their things again. Does that make sense?
Yeah, so then the next step is, can an arbiter be, what is an arbiter? Can it be a multi-sig? Could it be a contract with coin voting? Is it all of YAM governance?
It can be any arbitrary address, effectively. So the arbiter is an address, and the address has permission to determine whether or not an exploit was valid or invalid. And so that's effectively all it is.
Because I feel like an arbiter, sort of in the same vein, on what you're kind of getting at, I think, and feel free to correct me, like an arbiter could just change addresses if they pulled essentially like a coverage reg pool, or a bad faith denial of claims. I mean, they could just change to another address or create a whole other address and do it again, right? And there's currently nothing that could stop them, which I know that's generally the case for crypto at large. It's relatively easy for scammers to move on and do it again. But is there a world where we could require how much does it raise the complexity, I guess, if we require arbiters to be a multi-sig of multiple people or coin-based voting?
I'm curious why you guys think that that's a concern for us right now, because in our UI, YAM is the arbiter. This is all about YAM and exploring ways to mitigate damage of other arbiters is I don't know that it should be a concern right now.
That's true. That's a great point.
So the way I envision this going is anyone can be an arbiter, right? But YAM, our UI is only going to support pools in which YAM is the arbiter. And it's going to be similar, or unless we have, Chainlink partners with us because they want, and there's some agreement there where there's some split to have them as an arbiter on our UI. So unless there's going to be some arbiters are businesses, right? It's a business to be an arbiter. And so you're going to have to spin up some infrastructure to do that. And there may be an abstraction, an aggregator essentially that lets you see all of them. In which case there is the chance that you're going to underwrite for a bad pool, but it's like buying some Uniswap aping into some random Uniswap token. There's a decent chance that token is going to be bad. And so just because there's this aggregation layer that lets you get anything doesn't mean you should get anything. And you should generally think about who the arbiter is as an underwriter. That's part of your responsibility.
Okay, that totally makes sense. Yeah.
Sure. Or I guess, but you're in this context that you're speaking about basically pools that are set up outside of the YAM UI. Essentially, that's where the responsibility is. Do your own research, all of that stuff. If you're going through the YAM UI, the assumption is YAM is the arbiter. Now, how does that functionally operate though? Does that mean YAM governance is the arbiter? Anyone with YAM tokens can serve as the arbiter and essentially call that claim?
Yeah, so we can walk through the claim process here. So effectively, the way it's going to be set up in the YAMS ecosystem is we're going to have another governor and time lock that is basically our arbiter. So that's the YAM arbiter. It's separate from the main governor that governs our protocol. It's going to be a separate one, but it's going to use the YAM token as the voting. And so that will be, we'll do an on-chain vote essentially to determine whether a claim is valid. And for claims, essentially there's two paths. There's the automated path and then there's the manual claim path. The automated claim is if you had the coverage tokens will have snapshots. So like what we do for our current, for the YAM token, it snapshots basically your balance at various blocks when you do transfers and all of that. And so it basically keeps track of what your balance is at a particular block. The arbiter says the hack occurred at this block. Therefore, if you had your token in your address at this block, you can go and get your claim automatically. If you did not have your tokens in your wallet at the time, say you were liquidity providing on Uniswap, you can still go through a manual claims process And obviously that can be abused by bad arbiters. But for good arbiters, it's not an issue. And so that's kind of the claims process. I imagine 95% of all claims will go through the automated process, and it'll be a small number of manual claims.
So is that because we're giving them an ERC-20 that they can potentially move it? Is there an advantage to giving them the ERC-20 versus giving them a certain amount of coverage, but not handing them back a token that can actually be moved?
Yeah, so we can talk about this. This is one of the questions Trent and I have, and we want to bring it up, is talk about the benefits of an ERC-20 for coverage buyers, and some of the drawbacks as well. In general, I will say I prefer the ERC-20 user experience. But we can talk about that a little bit more. Trent, do you want to go into that now or later?
As opposed to an NFT.
Yeah, well, even in NFT, you have transferability. And so we have three options basically. No transferability, NFT, or ERC-20. So non-transferability definitely adds some benefits. Obviously, it allows you to, well, okay. Trent, do you want to go into this now or do you want to go into it later?
No, I think, yeah, now's a good time.
All right, so we've explored a number of paths here. So on the NFT, that allows you to do things that are specific to your account and your account only. So that allows you to do things like when you entered, like the exact start time, and it allows you to specify a duration of your coverage. That in particular allows you to know, it also allows you to get a static payout in theory. It's an entirely separate protocol to what we've specified here. It's more like what we've talked about before prior to this, where you know exactly how much coverage you have, and you know exactly how long you have that coverage. Versus here, you get in the ERC-20 world, you get transferability, you get secondary markets, you get the ability to cash out at any point for what's remaining, and in theory, you can have a more robust secondary market for coverage. Trent, do you have anything to add on? Yeah, go.
I just have a quick question on that though. If I feel like, well, so I guess I'm wondering on the claims process, why do we need to do a snapshot if the fungibility and all the benefits that you just said, like why couldn't we just use the ERC-20 as how you can claim something versus a snapshot of was that ERC-20 being held by the right address? Like basically, why couldn't somebody essentially sell their token? A hack happened. I've got a token that can now redeem for some value for that claim. Why does a snapshot one of the constraints around if that token can be redeemed for that claim? Does that make sense what I'm asking?
Right. So part of it comes down to mintability. So you can effectively mint whenever in the system. So if I bring $100 to the table, 100 DAI to the table, I can get my corresponding coverage token. And that non-fungibility to be able to, let's say a hack happens, Arbiter steps in a day later and says a hack happened. If someone minted between then, they would be able to go and sell that on the open market and then redeem. And then you're absolutely going to, the payout is you're absolutely going to get to the max utilization. Fundamentally, because people will know that, okay, I can go get 100% return on this. And so you'll instantly get all of these coverage buyers into the system, because the market hasn't been shut down yet by the arbiter.
So the quick solution to that I'm thinking, and I might be off base here, but why is there not just a time lock? The same as there's a 14-day period to exit. Why is there not like maybe a 3, 4, 5-day period to enter the protection pool? So you buy it today, but you won't be covered for any hacks for 5 days or something.
Yeah, we could do that. I think.
I quite agree with that. Mainly because in the current system, we're really not leveraging the fungibility. It's like we're giving up a decent amount to have this perpetual fungibility, and we're not really doing that much with it, because the only time you would really want to be like trading this thing is like once an exploit occurs, and like then all of a sudden the fungibility is quite valuable. And so putting the time lock and not having the snapshot, I think does add quite a bit of value to the current setup.
Are you, so let's play this out. In that time lock, let me think about this.
Because does that mean arbitration needs to occur in within that time lock span of time, basically? Like,
the market
otherwise
needs to be shut down. Yeah, the market has to be shut down in that time frame.
So basically what you would get is the time lock would mean that you pay now, but you don't actually receive the ERC-20 until later. So you would get it 5 days later, and then you'd have to go back, do a second transaction to actually claim your ERC-20. And I mean, you could leave it there. You wouldn't have to claim it.
Yeah.
But if you wanted to transfer it, you wouldn't be able to claim it the exact moment that you bought it. And that also means that there's a secondary market too, because if you want it right now, you could buy it from somebody else.
Yeah, I think there's something really valuable around the fungibility and the ERC-20 token. And so it'd be great if we could think about how we can leverage that to where there's markets and secondary markets and people able to trade around these tokens. I think it's really valuable. And I think having all of a sudden a snapshot feels like it's kind of going the wrong direction around that.
Yeah, I do agree. I think that's, and you actually do boost the value of the secondary market if you have a time delay in new purchases, for sure. That makes a lot of sense to me.
And then just so that I understand a little bit better, I know we've talked about these ERC-20s are going to be kind of elastic, like there's a balance of underlying. So I know with YAM, we're having to call sync on Uniswap pools and have smart pools on Balancer, stuff like that. Do we have those limitations on this ERC-20?
No, we do not. So it's much more like a C token. So like
Right.
Aave tokens, you have to call sync in theory. Now the interest rate's so slow that it doesn't make that much of a difference. But with these, it's balance of underlying that's changing, not balance of. And so that's do you have to call sync or not?
Perfect.
Underlying changes, you don't.
One quick question on I like to think of things of like the user flow. So let's imagine that you're a protection seeker, you get to the website. Are we going to have a mix of like these meta pools where it's like the DEX, get coverage for the DEX meta pool, get coverage for the yield farming meta pool, get coverage for this. But it's like, you know what, that's too expensive. I have a very specific thing in mind. I'm only using the ETH, Y vault. You're in vault. I'm just going to do that. And that would be a contract pool. So will it be a mix of like, okay, I can kind of get these bundles, which are kind of like these meta pools, or as a protection seeker, I can get very specific in these contract pools. Is that kind of from a protection seeker standpoint, is that kind of how you guys imagine it?
I think from the seeker perspective, currently the way I'm thinking about it is more going right to the specifics. For the underwriters, it's very much like, yeah, I want to underwrite the DEXs. I want to underwrite, the DeFi OGs. I want to underwrite whatever. Currently for the protection seekers, it's much more, okay, I'm going to search for the protocol that I want coverage on, and then I'm going to search for, maybe a specific contract that I'm looking to have covered.
Interesting. I actually am more along the lines of there will be definitely varying levels of conceptual, like how abstract you go with the contracts to more specified, right? And so as an underwriter, I'm getting paid to go more broad in general. I should be at least. And I can go more specific if I want a lower return. Coincidentally, if I am a seeker, then I can go specified and I can pay a lower rate. I just want CE, for example. There will probably be a meta pool that is specifying, okay, these are the C tokens in this meta pool. And so I would go to that meta pool and I would get the CE one. Conversely, if I'm using a broad range of C tokens and borrowing on Compound, I may go higher and look for a meta pool that's Compound, Aave, and DYDX, and I would just get the Compound coverage. That's how I envision it, is varying levels of specificity that chain will most likely reflect the different levels of funding rates based on the risk.
Can a specific contract pool be in more than one meta pool?
Yes. So meta pools are basically self-contained. So they don't know about other meta pools. And so in theory, you can have a Compound coverage does not necessarily, it doesn't affect another meta pool that is just C tokens. So they're separate entities, and yeah.
Yeah, so like you get it, this meta pool could have Compound and this meta pool could have Compound. Those are two separate Compound protection markets.
Okay. So can we, I mean, I'm thinking about like the user experience and like users, specifically the protection seekers initially. Because I think obviously it's a chicken and egg thing, right? You gotta have the supply and the demand. But do we imagine that we will kind of be we as in YAM and on our UI, that we're going to kind of create the defaults? Are we going to allow people to just go crazy? And is it kind of like the app store, and that we curate kind of what looks nice to us, but of course people can go and dig in the depths of everything that's imaginable? Like how are you guys thinking about like defaults and the pools that we would create from YAM perspective and whatnot?
I think most meta pools are going to be YAM created to begin, largely because we're not going to have like a UI for the meta pool creation anytime soon. I would imagine it's going to be all kind of contract based. So YAM is going to be creating those for the most part in the beginning. I think once we get to the point where kind of we want it to be more like Balancer, where anyone can create the pool that they want. I think that's where we get into this other mechanism, which has a lot of those advantages, which is, the Compound pool would be the only Compound pool, essentially. And essentially as a protection seeker, all the protection seekers are routed into one coverage pool, and all of the underwritten protection is routed and aggregated to that one pool. I think this is something that, when we get to a V2 in, 6, 12 months or whatever, like this has a lot of potential to really do some cool things. I think in the beginning right now, YAM also, YAM is going to be creating most of these pools, but all the time YAM has to approve a pool to be created if we want to be the arbiter. So we can throttle how many pools we want to be created, essentially, and make sure that any pool that's being created kind of fits within the framework of how we're doing things.
Cool. Is there a way to measure demand? Or and maybe this is just more of a product thing, or like it'd be nice if there was some way that we could, because I'd imagine as a protection provider, you would like to know where there's demand. You'd like to know where there are seekers who are willing to put in money to buy coverage, and then you might match it with your, providing protection. So do you guys have any thoughts on, essentially right now, it seems like the system only works if there's, protection providers staking capital, and then the protection seekers can come. But is there any way that you've thought about how to measure demand, like where all the protection seekers want to be putting money? Can they put money in, and then the protection providers can like match that before it kind of kicks in? Or any thoughts around that?
Total value locked in returns, like the higher, whatever, it's like there's some matrix you can make with total value locked on one axis and percentage returns on another axis. Like whatever is in this top right quadrant there, I think is what's going to have the most demand for coverage.
Right. But seekers can't put more money in than there is provision or supply, right? So that's what I'm saying, is like seekers are limited based on the supply that's in a pool.
Yeah, Mick wants a way to basically place like limit orders, like conceptual limit orders, right? Where it's like, I would love to have coverage on this and be able to signal that directly to underwriters and say, hey, yeah, I really want coverage on this contract. And
maybe that's a Discord thing and it's not an on-chain thing, but I think it'd be cool if DGens could immediately put a bunch of money into the protection seeking pool. And then it's like, okay, like now we see that there's real money here ready to pay us. Let's match it. Let's supply into that pool.
Yeah. I think it's a good point. And
so excuse me for interrupting, Brock, but you're talking about an on-chain or a Discord way to go, but maybe through the interface as another option. So that what we could do is set up a signaling wait list. And so that it's a chicken and egg thing, right? So we get people in kind of signaling what their interests are and put them basically on a wait list. The wait list serves as a signal to the providers, and the providers then can come in and fund. So this might even be like a part of the interface that could be pervasive, where as new pools are being created, they go through the same process.
Yeah, and another option is we just allow people to deposit prior to, basically when you create a protection pool, right? In theory, anyone can create a protection pool, right? And we just allow deposits prior to underwriters being there. I don't know exactly how that works from a technical standpoint yet, but it's a good point where it's like, all right, we have this pent up demand, therefore underwriters could step in and fill that demand somehow.
Yeah.
You might be able to throttle the creation of the ERC20 in that case, or like just delay it. So I'm just sort of walking through it in my mind, and I'm not sure I quite understand it, but say there's a new contract, new farming token, whatever pops up, you want to get coverage. So you go and as a protection seeker, go plop down $1,000, something like that. And you basically, there's nobody on the other side of that trade right now, $0 of actual underwriters. So you put down $1,000 in sought protection. And I know you're not like necessarily covering $1,000 because there's going to be that decay, but you're just basically saying, I'm willing to pay $1,000 to cover this contract. And then the protection seekers basically, I mean, I'm thinking, I don't know what that does to the utilization rate, maybe I think that's maybe the hard part that I'm trying to concept right now is that say a protection provider, so one of the underwriters puts $1 on the other side of that $1,000. What's that rate look like in that case? Because obviously the $1,000 isn't going to get covered except with $1. But what kind of fee is that $1 going to be receiving?
Yeah, I think the extra deposits. So kind of this idea of like there's surplus of deposits. There's just surplus. I think we put it to work. I think we put it with Aave, Compound, where vaults, wherever, right? Like so that there's not like money just totally lost for the protection seekers, but it's like, okay, at least my money's growing, but I'm demonstrating like interest. I want some coverage here, but it's a clear signal. It's like clear. You can't get more clear than that. Putting money at stake. That like I want some protection.
And that
Actually, you know what? I remember. Sorry. We talked about this a long time ago. Do you remember assurance contracts? I feel like that's kind of what this feels like. Is that an assurance contract is it's an economically efficient way to basically get group protection or to indicate that you want to act as a group. And it basically means is that $1, that first dollar that gets staked against as coverage against the $1,000 seeking coverage, it almost all gets paid out in a year or a month or whatever that bonding curve rate looks like. So that first dollar has an insane return, which means it's going to get $2 and $3 and then $100 until that curve comes down. So you really do quickly incentivize coverage, even for the degen farms, right?
Yeah, because if there's $1,000 in waiting and I go put $100, if I go underwrite $100, I know that that's going to be at the max utilization and be earning the highest funding rate possible. I love that you brought up the assurance contracts again. I think it's a great, it's a great analogy. And it doesn't feel like that would be too hard to implement technically. Yeah, I think that's an awesome idea.
But also one thing Mick said is about putting the money to work. So that's an interesting concept that we can talk about here is the optionality for coverage for pool creation, like supplementing it adds risk.
All
here.
capital should be put to work. All capital should be put to work.
I agree.
Whether it's the protection provider or the protection seeker, all capital should be put to work. Don't just leave it sitting in a contract.
Right, and so that's what the current
and YAM takes a little bit of that. Takes a little bit of that cheddar. YAM takes a little bit of that.
Yeah. So the thing about that is this is a protection protocol, right? So you're instantly you're adding risk to something that should be exclusive of that. But that doesn't mean we have to entirely get rid of that. And one thing that kind of path opens up is like integrating the actual underlying, it adds complexity significantly, but like where does that capital go when like, all right, so I want to get protection on DYDX and I trust Compound. So this meta pool uses the deposits for a concept and puts the DAI that I put in into Compound. And so then I'm earning interest on my DAI that helps cover some of my funding rate. Similarly, the protection pool, any capital underwriting this stuff is also put to work and earning you money. I think we have to allow it to be specified. I don't think it should be enforced, but it's definitely something to consider here.
Yeah, and I don't think this needs to be a V1 feature, but this is a great idea for an optimization to make it better, to make sure people feel like their money's still being put to work in some way. So I think it's a great thing to explore in the future.
I know this conversation is primarily dedicated to YCP, but as you were saying, as a secondary V2, further down the roadmap feature, if later down the road we do have some sort of lending platform built for YAM, I mean, this is an asset that we could definitely build some kind of functionality around to leverage.
I wasn't going to bring it up, but you brought it up. I agree 100%. This is another reason why we need our own money market.
But again, further down the roadmap, let's get an MVP out the door first.
Yeah.
Okay, I think this has been great conversation on the first concept. Trent, do we want to touch on the second concept, or are we just totally relegating that to a V2?
Can I throw out one last question before you make that decision? One thing I don't know how many people own houses, but often you'll have in your insurance a stipulation that floods aren't covered because you're in a flood zone or something like that. And I know we're going to have a lot of these coverage, these conceptual pools where they cover all of Uniswap or all of Compound or something like that. In my mind, DeFi's flood problem is flash loans. So I see a lot of pools that say we'll cover anything except a flash loan or something to that effect. So do you see that as being, so when we're defining these conceptual pools, it's basically like a string in the contract that is the description of the pool rather than a series of contract addresses?
Yes.
Yeah, okay, cool.
I guess to that same point though, this is something I was wondering, with these higher concepts, not using like contract addresses, I guess like what happens if there's something that is ambiguous enough that users feel like the arbiter made the wrong call, right? That's it's vague enough that something wasn't covered or whatnot. I guess what I'm trying to get at is like, our goal is to keep this decentralized, keep it on chain, right? But like, if someone loses enough money, there's always a risk that, they will go after, go outside to, more traditional court systems, that kind of thing. How can we make sure, in the insurance industry, right? Typically in the insurance industry, they parse all the different types of coverage, like to a very fine degree for that reason, right? They want to make sure that everyone is very clear on this is what is being covered, this is what's not being covered, or at least they want to make sure that legally it's very clear, right? Is there a way for us to do that programmatically so that, there's no doubt if something were to come up?
It's a good question. I think we're going to have to be really specific in the language that we use when we're creating our own pools. And, potentially like make them a little bit legal easy. I think we're going to have to get some pro bono lawyer reads on it.
There's two paths, right? You can go specified or you can go broad and lean towards paying out, right? So, and part of it is on the underwriter and part of it is on the arbiter, right? So I, as the arbiter, I have to be very clear as to, all right, I'm going to be liberal with my definition of a bug, hack, and exploit. And basically, if there is something we don't want covered, you have to be explicit about that. And I think in general, if you lean towards, Yes, I agree. It's a difficult thing, and part of it is you have to balance. It ultimately, the coverage buyer and the underwriter both have to trust that and understand that the arbiter is the one that gets final arbitration on the matter, right? It's like going to Judge Judy instead of an actual civil court, where you're agreeing basically that this third party has final say over the matter. Just like
Is
So
there
I have a
a
question.
legal service or something? I mean, I know they exist. Like, I mean, that we could somehow integrate where like we just have a boilerplate that gets signed with your wallet or something that like when you deposit, so that way you acknowledge, like, yeah, I'm, you know, the arbiter has final say here.
I think something like that makes a lot of sense. Yeah.
Yeah,
So,
part of me worries
Run
about
into
getting too
jurisdictional
legal.
issues, you know, with,
Yeah,
I mean, it's an international crowd, but still.
I'm worried about getting too legal because I agree with Brock in that this is if people are buying protection, like they're trying to protect their money from any of these types of attacks, right? Whether it be a flash loan, whether it be a bug. You know, yesterday or a few days ago, the percent was just like a bad upgrade. It was like upgrading the interest rate model. Like people just want protection on their money, and they don't. So I worry about when we get really super granular around the possible permutations of that, we're going to miss something. Because it seems like there's new things that are happening all the time, but it's just the spirit of it is that they just want to be protected. They don't care how it happens, but they don't want to lose their money. So I feel like it really needs to be kind of all encompassing on the protection.
And I hear that, and I agree with you. I think it's just I guess I'm concerned that like there's going to be a form of protection that we just threw, like not out of in any bad faith or anything or malfeasance, but we missed, right? Like if we're setting up these initial contracts and like you know, and then if it's not covered, you know, hopefully the arbiter leans towards, you know, being more inclusive, you know, but then we start getting into like, okay, well then like, is there potential for coverage creep, right? Whereas like, you know, sort of some conversations we've had earlier were like what counts as a hack and what doesn't, right? And so, you know, what happens when people feel like they should have been covered but weren't? Because you're right, people just want to be covered, but what happens when they feel like they weren't covered appropriately? That's my concern.
So take notes from Nexus Mutual, right? So they are a mutual, not insurance. So are we. We are not insurance. We are much more along the lines of a mutual or something to that effect, right? And so it is entirely up to the mutual whether or not they pay out, except for the fact that the underwriters aren't the ones determining the payout. It's a third-party arbiter. So
I also think we can probably table this part of this discussion for a little bit later, mainly because we're running, I think, probably quite long on time, and I don't want to beat it to the ground. And I think that it's like going to be a whole nother separate discussion that I don't think we are like fully prepared to dive into. And I know Fetus had another.
Yeah. Sorry. This is kind of out of left field, but you know, we're talking a lot about the people that want to buy protection. The people that are staking, the underwriters, seem to not. There's not a lot of benefit, especially if you're pooling multiple contracts together. So in you know, I used to deal with some life insurance. This is out of left field. I don't know if this makes any sense at all in this case, but the premium payers, there's no underwriters in terms of other people staking their money because they could lose it all. But you find a way where the premiums that get paid get thrown back into the pool that essentially get distributed if there's an issue. So instead of having like a system where one person loses, the other person wins, or vice versa, one person wins, the other person loses. Everybody's kind of in it together. Everybody puts the money together. And then those premiums that are depreciated over time get added back into the pool, which increases the payout. You might need something like YAM to seed the pool to put the initial coverage up, because you're not going to have a ton of premiums paid in to grow the pool. And then whoever seeds it gets some extra benefit, meaning that they get once the pool gets to a certain amount, they can pull out all of their seed money plus an additional 50% or whatever. And then while the pool is still growing with other premium payers. So this is kind of how life insurance works. Everybody puts all their money in, but as far as what the contract pools are, you kind of rate them as you put all the similar contracts with the similar risk in one pool. And then if there's high risk contracts, you put them in another pool, kind of like if your life insurance, if you smoke, you're at a higher risk. So you get charged more, but at least, you're kind of all in the same pool together. I don't know if this is.
Yeah. And I think that's one of the things that we're going to try and do with some of our pool creation. But I think, so your first point was like, what's happening to those premiums? Are they being reinvested in the pool, or are they going directly to the underwriters? Is that correct?
So my idea is that there's no underwriters at all. Basically, you just have premium payers, and then all the premium goes into a pool, and essentially your premium payers are the underwriters. So you have multiple contracts. Whoever wants to buy a protection on urine, you put your money in, and then your premiums get basically thrown in the pool. And then if something happens to one of those contracts in the pool, you take the premiums from everybody else.
Right. The issue here is that you have to have an actuary for that to be able to price different aspects. And so that's how the other way works, right? Is you're able to price an individual contract or whatever, and therefore those premiums actually do accrue at a market rate, as opposed to the way we're doing it now. Is the reason we have underwriters is so that a market rate is emergent, as opposed to and discovered, as opposed to a third party stepping in and saying, this is the market rate for this contract, right? And so if you might be able to do a merging of the two ideas, where initially you have some sort of market price discovery for it, and then that over time transitions to just being premium based. And so you have these premiums that accrue, and part of it goes into this other pool, and you do a normal insurance type strategy. But currently we have no way to price these things outside of supply and demand.
Yeah, and I think that's we're talking about protection for the people who want to buy protection, but I don't see a lot of incentive for people that want to offer it, people that want to underwrite, pools of contracts, because, the returns vary depending on who's buying it. So you don't know what you're going to get out of it, number one. That there is contract risk. The risk and return, you've got to, kind of determine what you're willing to risk and what you want the return to be. But it's at first it might be good, but then, you want to take out because it's the returns aren't there.
Yeah.
Right. So basically, if I've got $100,000 as an underwriter, and I'm going to underwrite Harvest.Finance for $100,000, and I'm going to earn 20% on that or something like that, I'm basically taking on 100% of that contract risk. And if I just didn't underwrite Harvest.Finance and I just invested it directly into Harvest.Finance, then I could be making 50% APYs or 100% APYs directly, right? So where's as an underwriter, I need to be somewhat risk off, right? To get, if what I'm doing is aiming for a certain yield or a certain payout, the money, it's kind of got to come from somewhere.
Right,
And
so-
then
Yeah, but
maybe
I
it
don't think
comes from over time, right?
Yeah, but you wouldn't lose 100%. I mean, I guess it just depends. But in theory, you wouldn't be if you were to go directly to harvest, you could lose 100% of your money. If you were to supply, be a protection provider in this protocol, I mean, hopefully you wouldn't lose 100% of your money. I suppose there is a scenario where that's possible, but so it is less risk. You're not taking on exactly the same risk. Plus, you could spread that risk among a meta pool, right, where harvest is only one of those. And so you're spreading your risk around, and if that's the degen meta pool where it's all high risk contracts, then you could potentially be getting a much higher rate than you would, anywhere else. Plus, you're getting those tokens, which we're not talking about here, but someday I'm excited to talk about.
Would you be spreading risk in a meta pool, or would you be multiplying a risk? Because if any of those contracts get hacked, then you're going to lose your underwriting, your money.
Yeah, maybe we need to take this this offline, but I'm trying to understand the details of this. The money that is left over after the utilization rate, where is that money coming from? Is a meta pool, as Fedis is saying, is a meta pool like having leverage here? Like, am I insulated or am I leveraged?
So in general, you'll be insulated, particularly because you, as assuming it's a well-balanced grouping, right? If you have a highly unbalanced grouping of contracts, meaning one concept is way riskier than the other concepts, then you as an underwriter don't want to necessarily participate in that pool. You want to be spreading your risk amongst like risked contracts, if that makes sense. So Compound, DYDX, and Aave, all well-vetted lending protocols. And so more than likely, you'll have comparable level of coverage buyers on each of those, depending, it'll be slightly off because they have different level numbers of users. But in general, you should be getting a lower risk product than being in all three of those.
One thing that might be interesting to explore and maybe add this as part of the roadmap down the line would just be, again, I know like if the coverage is determined by these sort of bigger picture concepts, that's cool. But like maybe in the underlying contracts of it all, specifying again specific contract addresses, but like that could give us the ability to like parse like different pieces or different like coverage for different pieces of a protocol where like what is specifically breaking. Like maybe you're just like really concerned about the controller for Compound, but like you don't think there's any risk for a different contract within the overall protocol, right? So like that's something that then the market could kind of determine help determine those rates and just give people a chance to diversify in different ways, right? And also just be more flexible if you're like someone seeking coverage and protection, right? I mean, we all know things change on a case-by-case basis. The code gets updated, at different rates, and so like the inherent risk for different parts of a project is going to change over time. So that might be helpful for us.
Yeah, I think I love the idea of getting really specific as well as having some of the broad stuff. I think my last question is just around kind of fees and whether we think that there should be a fee just for the arbiter or also a fee built in for the treasury.
And I'll say this very quickly. I don't think we should dwell on this, but I think that's a good, I think it's nice to have something like Uniswap where assuming we do a token, it would actually accrue into the token. I know that potentially splits up kind of where, anyways, I think we should maybe touch on it very quickly, but I don't think we should dwell on it. right now. I think it's a good spot for the token to accrue some value, not necessarily direct to the treasury.
Yeah, I agree with that. If some percentage of all the fees, all the revenue, went to token holders or token stakers or some version of that, I think that would be a great mechanism to help grow the value of the token, which hopefully in turn grows the value of YAM.
Okay, great. Thank you, everyone. This has been awesome to hear everyone's thoughts. Let's continue to have conversation on this. Sounds like there's a number of things to still be worked out, but want to thank everyone so much for their thoughtfulness and ideation on this.
Before we end this broadcast, again, for anybody who has been watching and had questions, or anyone who's catching up and has questions later on, the channel for YCP on the Discord, it's just that, pound YCP. And then obviously we'll be reposting this in the forums and that sort of thing. And also for future governance calls, we're trying to get the link out for this Zoom meeting, so that way people can join and just ask questions in person as well. So we want to hear what you think as this thing gets more and more put together.
Cool. Thanks, everybody. I'll post kind of some summary notes in the forum post with the agenda and some things that we talked about. Yeah, super productive. Definitely appreciate all the feedback.
All right. Thanks, everybody. And gonna go ahead and end the stream.
Thank you.